All right, well, welcome everybody. This is our first all-client Zoom market update of 2024, and actually our first update since August of last year. If you can remember August of last year, we were in the middle of the first correction of this new bull market. And so there was a really good reason for us all to get together and talk because I was telling you at the time, hey, this is a correction. These things happen. The bull market will continue. And then the good news is, fast forward to today, that did in fact happen. We ended up having a huge November, December, and the market has continued up so far this year. So in our presentation today, we'll be going over this bull market so far. I'll also give you an overview of kind of a little bit longer look at the market and the economy, so you can really hone in on where we are in the process. It's really helpful to understand, where we are based on looking at where we've been. Okay, we're also going to go over at what to expect of a bull market. What should you expect over the next 3 to 5 years in your portfolio, in the market? The last thing I want is something surprising you, right? So give you some good expectations. We have a really cool new tool to show you. It's kind of a new look at diversification, a tool to kind of better help you understand why we diversify your portfolios the way we do, and how we use this tool internally for things like rebalancing, distribution planning, tax loss harvesting, all of that. Then we'll finish up today with a review of interest rates, the Fed, and of course, the big thing this year, the election. If you do have questions along the way, please feel free to unmute and ask. Otherwise, I'm going to go ahead and mute everybody to keep any background noise down. All right, let's get into it. Okay, so as I said, it is March 8th today. The bull market so far, and a look back. All right. So this is a look at the last 17 months of the S&P 500. So that's the bull market so far this year. Now, as you can see, I circled the first correction that we had of this bull market. So last summer, August, September, October, we had a drop of a little more than 10%. That is a classic correction. Okay, corrections tend to happen when either people's expectations change, or with changes in investor sentiment. Okay, so at all times people are, overall sentiment is either optimistic or pessimistic, right? So corrections happen when either sentiment changes all of a sudden, or when expectations change. In this case, it may have been a little bit of both. Expectations about what the Fed was going to do and how quickly they were going to raise interest rates began to change in the summer of last year, and people started to get worried that the Fed was going to raise interest rates too quickly and maybe we were going to go into a recession. Thus, the market corrected. And then those fears did not realize, and the market continued going up. Okay, that will happen again. Okay, but to better understand this new bull market that we're in, which we're now about 17 months into, let's take a step back and look a little bit further. Okay, so now we've zoomed out. Now we're not looking at the last 17 months. We're looking at the last 2 years. And you can see I've mapped on here, the bull market that we have, but now I've also added the previous bear market. Okay, so you can see, again, the S&P 500 is the chart, and you can see the 10-month-long bear market matched up against the following, so far, 17-month bull market. Okay, now it took us almost this last 17 months to reach a new high in the S&P 500. Okay, so in previous calls, I called that full recovery, right? How long will it take to reach full recovery, where we make up for all the losses of a bear market and get back to new all-time highs? All right, so you can see that we achieved that earlier this year, and the S&P 500 has gone on to set new highs. All right, so now let's zoom out again. Okay, now we're going all the way back to COVID. All right, now we're looking at the market from January of 2020, right before the COVID crash, all the way to today. And you can see the little circle of the correction we had this past summer keeps getting smaller and smaller and smaller, right? That's your point of reference. And so you can see the COVID crash lasted about 19 months from start to the beginning of the next bull market. Now, it was a COVID crash, but it was also a COVID surge. Okay. I know all of you guys remember all too well all of the money that the government pumped into the economy during the COVID crash. That largely fueled the COVID surge, okay? This surge to new highs of profitability for companies and thus new surge in stock prices, okay? But we paid for that. We paid for that with higher inflation, all right? And that is what spurred the Fed to begin raising interest rates, causing the 2022 bear market. Okay, so we're all on the same page. Now, it's kind of interesting to realize that from the beginning of the COVID crash to today, the market is basically 50% higher than it was right before COVID. Okay, it doesn't feel that way. I know most of us feel like we've been treading water for the last 4 years, but that's really not the case at all. The economy is growing and the stock market is growing pretty significantly, 50% over 4 years, right? Despite 2 big drops along the way. All right, so let's zoom out again. Okay, big, long look. Now we're going to look over the last 16 years. See that little dip on the left side of the chart? You know what that little dip is? That's the Great Recession. That's the banking crisis of 2008, is that relatively small looking dip on the left there. Of course, in the moment, it was huge, and percentage-wise, it was huge. But it's amazing to realize that the economy and specifically the S&P 500 has tripled in value, more than tripled in value since 2008. So over the last 16 years, right, tremendous growth. And now that little correction we had last summer is now just a tiny little circle on the back there, okay? So the other thing to realize is kind of moments in time, right? We had the Great Recession and what I call the sugar high bull market, which lasted over 10 years. Okay, that sugar high bull market was one of the longest and smoothest, relatively speaking, with the least number of drops along the way, bull markets that we've ever had. Now, I'm calling it a sugar high bull market because I believe a lot of that was largely fueled by historically ridiculously low interest rates for a very long time and trillions and trillions of extra dollars pumped into the economy. And the inflation that we felt in 2021 and 2022, and we still feel today, is still due to all of that money being pumped in from the Great Recession, maintained through the sugar high bull market, and then doubled down on during the COVID crash. Okay, so we had all this extra money. Now, the 2022 bear market and even the economy today is us getting back to a balanced diet. Okay, we're getting off of this sugar high that we've been on for a decade and a half. And now we're kind of getting back to a balanced diet, an economic balanced diet. All right. And the inflation pain that we suffered the last few years has been part of getting back off of that sugar high. Okay. So that's where we've been. Now, what to expect going forward? All right. Now, this is a chart that I showed you very early on in 2022, and I'm showing you it again just to reinforce what a relatively normal cycle we've been through, okay? When we first realized that the 2022 drop was going to be a bear market, I put this chart up and I showed you guys, okay, in a typical correction, the market drops 10%, and on average has recovered within 4 months or at most a year. But for a bear market or a recession, it typically will take anywhere from 16 months to a little more than 2 years to reach full recovery. Okay. And in fact, we did it in about 2 years. It was very, very, very average. Okay. So even a few months into the bear market, I ended up being spot on about how long it would take for the market to recover. Okay. Took about 2 years, and I told you it would take 16 months to 2 years. All right. So that's the only purpose of this, is just to say, hey, listen, this is, certain things, they're not predictable, but we can be informed by looking at previous cycles. And oftentimes, normal is normal. Okay. All right. So here's where we are in the economic cycle. And I showed you this chart in our last meeting also. Okay. In every economic cycle, you have an expansion, you have a peak, you have a recession, you have a trough, and then you have a recovery. Okay. We are square in the, right along the way of the recovery. Now the concern all along the way since this recovery began has been, is there going to be a double dip? Are we going to go into recession? Last year, I had PIMCO on the call with us, and they were giving all of us their market outlook, and they were predicting a recession. To be fair, they predicted a recession in 2023 and in 2022, 2023, and 2024, and they were wrong every time. And I told you that I disagreed with them, that I did not think we were heading into recession, and I still don't, okay? Matter of fact, I think the likelihood of this double dip or the likelihood of a recession is less than a 20% chance. That's the same thing I told you in August of last year, and I still feel the same way. It's possible, but I think it's extremely unlikely. And that's why, as you'll see in the management of your portfolios, there's a lot of there's a lot of optimism in the way I'm managing your portfolios. I'm managing it for growth, to take advantage of what I think will be a continued recovery in the economy and the stock market. Okay, so corrections. All right, we already had one last year. You should expect us to continue having corrections all along the way. In fact, if history plays out and averages play out, we should tend to have a correction once every 12 to 18 months. Okay. The last correction was in summer of last year. That means it is very reasonable to expect that we will see a drop of 10% at some point, either this year or early next year. And it'll probably take anywhere from 2 months to maybe as long as 4 to 6 months to recover from that correction. It's totally normal. That is just what happens along the way in bull markets. And again, that happens when either sentiment shifts a little bit or when expectations change a little bit. Okay. So this chart is meant to show you the difference between a correction, a bear market, and then a crash. Okay. COVID was a crash. All right. That was a sudden and shocking drop in the market. The COVID crash was the quickest drop in the market we've ever had in history, even more than the Great Depression. All right. Versus a bear market, which is what we experienced in 2022, which is kind of a slower drop in the market. And specifically, the 2022 bear market took 10 months to go from top to bottom. Versus a correction, happens over a month or 2 months or 3 months. In the case of last summer, it took about 3 months for the market to drop about 10% before then recovering onward and setting new highs. Okay, so what to expect of a bull market? Bull markets are really exciting, okay? Oftentimes they deliver much higher than normal returns. Okay. And the reason they deliver higher than normal returns is they have to offset the bear markets, right? So that overall, we're still hitting that average return target that your portfolios are designed to achieve. So here are some bull markets going all the way back to 1926. We see some really crazy bull markets that delivered, close to 500% return. We see other bull markets, 367%, 200%. But I think a normal expectation, for you guys, for your portfolios, which of course are not 100% stock, Most of you guys have my retiree portfolio, which is much more balanced. So an appropriate expectation of what this bull market will deliver is anywhere from about a 50% to 100% portfolio appreciation from start to finish of the bull market. Okay, so starting from October of 2022, which was the beginning, to wherever the end is, probably 5 to 7 years, right? Or 3 to 5 years from today, 50 to 100% appreciation. So far, you guys have already booked about 15 to 20% appreciation in your portfolios. Okay, again, depending on the exact mix that we have for you. Okay, so we're well along the way of what would reasonably be expected of this bull market. Okay, so now let's shift. I want to show you a new look at diversification. Again, this is not a change in strategy. This is just illustrating the strategy we've been using in your portfolios for a decade now. It's just illustrating it in a new way that hopefully will shine a light on it for you and just make it easier to understand. Or it may just be crazy complicated. We'll see. Okay, so this is something called the periodic table of investments. Sometimes it's also called the quilt chart. We did not invent this. Okay, I am not taking credit for this. We totally ripped this idea off from other investment companies that have been doing this for many decades. But what we did was we applied it to your exact portfolios. Okay. So these all represent the actual investments that you guys hold inside of your portfolios. Okay. And what it does is each position in the portfolio has a unique color. Okay. So starting at the left of this periodic table of investments, you'll see 2022 first quarter, Q1. Okay. The best performing investment in the first quarter of 2022 is the investment that's on the top of that chart in gray, commodities. Okay. Commodities were up that quarter over 25%. So yay, good job, commodities. All right. Now, if you want to see what did commodities do all along the way in the following quarters, just look for the gray box and you can see where commodities stacked up at each quarter going forward. So you can see in the next column, Q2 2022, commodities were down. They were down, but they were still the third best performer in the portfolio. Why? Because that was right in the midst of the 2022 recession. Okay. So commodities were down about 6%. The following quarter down about 4%. The following quarter down up 2%. Then you can see them trailing on the bottom of the chart, kind of the following, 3 out of 4 quarters. All right. And so the point of this chart is to understand that there is no such thing as a good investment or a bad investment. Okay. All of the positions in your portfolio are all good investments. None of them are ever bad investments. They're just investments that fall on bad times once in a while and then respond with good times later on. So there will never be a time where I go to you and say, hey, US value is really a bad investment and we're just going to get rid of US value. There are just times when US value is underperforming compared to some of the other things in your portfolio. Okay. And we can actually see that very clearly when specifically with value. Value is also on the the top left-hand side of this chart in blue. And its counterpart, large cap growth, is in a slightly darker blue color all the way on the bottom. Okay. Most of the time, growth stocks here in the US are like tech stocks. Okay, you can kind of think of them as tech stocks. All tech stocks are not growth, and all growth are not tech, but it's a good, easy way to think of it, right? So in the first quarter of 2022, in the first quarter of the last bear market we had, growth dropped significantly. And then the next quarter dropped significantly and continued to drop. Meanwhile, value, though it was either flat or down, was not nearly as volatile as growth overall. But then as soon as the bull market started, growth all of a sudden shot to the top, right? And for 3 out of the 4 last quarters has been the best performing investment or one of the best performing investments in your portfolio. Okay. So again, this is a way to understand the diversification of your portfolio and a difference in thinking about the investments, not as good or bad, but as good at different times. Okay. So then how do we use this? Okay. This is the same exact chart. Okay. The same exact investments in the same exact order, in the same exact time periods, but with different colors for different meanings. This is called a heat chart or a heat map. And what we've done is we've colored positive returns in green and negative returns in red. Okay. And what you can see is that most of the time, though not all of the time, the 2022 bear market was a big exception. But most of the time, no matter what's going on in the economy, there's something in your portfolio that's up. Okay. And it's that mechanism, the fact that there's something in your portfolio that's either up or stable, that is what allows us to keep the distributions going from your portfolio without ever having to sell low. Okay. If we can just stick to the paradigm of buy low, sell high, and thus don't sell low, we can maximize your returns, right? So, in periods of time like the bear market that we had in 2022, it was really hard to do that, okay? Because we had 2 straight quarters where pretty much everything in the portfolio was down, though some weren't down that much. Okay. Now, it was during that period of time that we sort of fell back and started talking about our backup plans. And for many of you, backup plans included using a margin loan on your portfolio. It included using sources of cash, like emergency fund cash, or it involved tapping into home equity, either through reverse mortgages or home equity lines of credit, in order to bridge that sort of very unusual moment of time when everything in the portfolio was down. Now, that being said, it only lasted 6 months and it was actually no big deal in the end. And we were immediately rewarded for our patience with huge returns in Q4 2022, Q1 2023, and Q2 2023. All right. So we use this tool for both rebalancing, because you can clearly see where the rebalancing opportunities are, where we can sell something high and buy something else low. We use it for distribution planning, just like I touched on. We also use it for tax loss harvesting, right? If an investment temporarily drops in value, we can sell it to create a tax loss that'll save you money on your taxes that year and the following years. And buy something that's almost exactly the same, so that when it bumps up the next quarter, you're not losing out on the appreciation. All right. Okay, let's move into the final phase of our presentation today. We're going to talk about interest rates, the Fed, and the election. And for this next part, I'm going to be turning it over to our financial planner, Dru Brooks.
Hi, everybody. Thanks for joining us. So, as you've all heard about interest rates in the news over the last few years, you've heard some of it about the Fed raising rates. And what that does is you can see back at the beginning of the coronavirus, interest rates were basically negligible, around zero for short-term rates. And then as we get into 2022 and, the underperforming market, you can see as the Fed slowly raises interest rates, quarterly and almost every couple months towards the beginning of 2023, that obviously affects short-term interest rates, but long-term interest rates are affected a little bit different. So first off, on this chart on the right here, we'll look at the light blue line, which is indicative of a normal interest yield curve, where the shorter term that you have your money locked in, say you asked a bank for a 1-year CD, and back in the day, they would give you around 2%. And then if you were to ask for a 5-year CD and have your money locked in for 5 years, you would expect to earn a higher interest rate. What we have currently, as of the end of February of this year, in the dark blue, is what we call an inverted yield curve. So short-term rates are higher than long-term rates right now. And the Fed has a bigger piece of affecting short-term rates than long-term rates. A lot of, in the news, you'll hear that an inverted yield curve can lead to a recession, or is forecasting the possibility of a recession. However, this time might be a little bit different, as the Fed's been so involved in bond markets right now, and their goal isn't to make as much money as possible. So it does affect interest rates, and which also affects the ability for businesses to have affordable loans down the line. So if a business needs a long-term loan and the rates are still high for the long run, that really can impact the opportunity for businesses in the future. So even if the Fed starts lowering interest rates, that does not mean the long-term interest rates will fall just the same. And I think Jon has some comments revolving around that.
Yeah, it's I'm sure all of you guys have heard about the expectations that the Fed will start lowering interest rates. And I think that might happen this year. I'm not as confident as some others about them lowering interest rates this year, but it's important to understand that the Fed deciding to lower interest rates only affects those short-term interest rates, only affects the left side of that curve. All right. It does not directly affect the longer term debt, okay, the right side of the curve. And if you want to really geek out with me for a second, the Fed did something called quantitative easing following the Great Recession, and then they did it again during the COVID crash. Quantitative easing was where they went out into the bond market and they bought up a ton of long-term debt and mortgages. And they did that in order to bring down long-term interest rates, which is not normal. The Fed does not mess around with long-term interest rates in normal situations. But given how serious the Great Recession was and how serious COVID was, they went out and did that. So they did quantitative easing to bring down long-term interest rates. Now they've started doing what's called quantitative tightening, okay, which is where they're now letting all of that long-term debt that they bought, to the tune of $22 trillion, by the way, they're starting to let that fall off of their balance sheet. They're not selling, okay, but they're also not buying. They're just kind of holding it and letting it mature, and that's it. So it's a very passive way of trying to get themselves out of this hole that they dug by buying up so much of this long-term debt, okay? But the fact that they're holding this long-term debt is artificially skewing supply and demand in the long-term interest rate market, okay? They are not a rational investor, okay? They're not an investor out there to make money. If they were, they would be selling these long-term bonds like crazy, but they're not. They're just holding them, okay? And I believe that is artificially keeping long-term interest rates lower than they otherwise should be, okay? So I am one who believes long-term interest rates are going nowhere. They are definitely not going down. I think long-term interest rates are going to, at best, stay where they are, and I think even possibly they might start to go up. But that is a minority opinion out there. You don't hear a lot of people talking about it, except in the very geeky parts of economics. But we are very shy about buying into long-term bonds for you right now. We're really just not interested in doing it because of this risk. Okay. All right. Let's keep going. Okay, so elections are coming. All right, this is the same exact slide I showed you in August of last year, and I'm showing you it again because you may have forgotten, but it's even more important to talk about right now. Okay, you are going to be hearing over the next several months from social media outlets, traditional media outlets, from politicians, and from scammers and people with a financial interest that you should be panicking over this election. Okay, that whoever you don't like, if they win, it's going to mean the apocalypse and the collapse and the end of capitalism and the end of our nation, right? Whoever you don't like, that's going to be the outcome, right? And I'm here to tell you, you can just ignore it, at least for purposes of your portfolio. You should not ever be making decisions about your money based on what's going on in congressional elections or in presidential elections. All right, it's just not a material factor, okay, that you should be considering. By far, you should be more interested in what the Fed is doing, okay, with interest rates and then planning your own tax strategy, okay, to minimize taxes for yourself. Those are two much bigger impacts on your financial well-being than anything happening in the White House or Congress. Now, if that changes, if I do start to see something coming down that you should be worried about, I promise you I will tell you. But there is absolutely nothing going on in politics right now that you should be concerned about for your portfolio. However, that being said, this election season will infuse volatility into the stock market. Anytime we have uncertainty, okay, anytime the end result is unknown or uncertain or could go one way or the other, business owners change their decision making, okay? They hold off on big decisions. They hold off on big investments. They hold off on hiring, right? Until they see what the landscape's going to look like, until they know what business tax policy is going to be, right? Those types of swings send the stock market up and down wildly, okay? So I promise you there will be lots of volatility this year, okay? But I also tell you that I strongly believe it will not interrupt the upward sloping movement of your portfolio, okay? It's just going to be a little ragged along the way. Okay, so what are my thoughts and predictions? Again, this thought and prediction I made in August of last year, and I'm making it again today. I feel like there is a greater than 80% chance that the market recovery continues through this year and continues into 2025. And I think there is a 15 to 20% upside to your portfolios over the next 2 years from this bull market. I think the Fed may lower interest rates this year, but we will not see long-term interest rates drop, okay? I think inflation will continue to slow despite little reports we'll get along the way of little spikes here and there. Overall, inflation is going to continue to go down, and we will see GDP growth positive, and that positive GDP growth accelerating, all right? And again, I think that's going to last another minimum 3 years, more likely 5 or 6 years. All right. So, Dru and I, we are here. We're your financial planners here at Village Wealth Advisors. We're here to help you. We're here to answer your questions. We're here to game out scenarios in your own financial life that you're worried about and help you understand the cause and effect of those decisions. I want you to know that you don't need to understand every single little detail of these presentations. This is to make you aware of kind of the big picture of where we're at, of where you're at, and so that you know that our decision making and our advice is filtered through objective analysis, and we're not just shooting from the cuff, right? You understand what we believe, you understand why we believe it, and I think that's really important to each of your decision making. So please do reach out if you need to chat. I know we've got meetings coming up with every single one of you guys at some point this year. But if you need to talk before then, if you're nervous, if you're worried, if you have a question, never hesitate. We are here to help. This is why we do what we do. So thank you so much, everybody, for being here. We will get a copy of this video sent out to everyone. And yeah, I'll open it up to questions. If you have a question, go ahead and unmute yourself.
Hey, John, I have one question. I keep getting information from Schwab about, I guess it's things that you're doing because I'm not doing anything. So do I have to pay attention to all of those things? Because I look at it and I'm like at a loss. I'm just not sure what all this stuff is.
Yeah. So Schwab is required to send lots of different things. Obviously, monthly statements, but also trade confirmations every time we buy or sell in your account. You're also required to get prospectus on the investments that you hold in your account, and you get something called proxy votes, which are voting yay or nay on corporate decisions. Okay. You should look at all of it. Right. I certainly would never tell you should ignore any of it. Right. But probably most of it, you're not going to be very concerned about. Any other questions before we go? Yeah, Steve.
Yeah. Hey, can you hear me?
I can.
Okay, good. I have 3 questions. The first one is on that quilt chart that you showed. I looked at all the bonds, and every year they were negative practically. So why have them? I mean, when they're supposed to perform, they don't perform in 2022 specifically. So why have them? It seems like in a portfolio like mine, where it's heavily weighted because I'm retired, it doesn't make sense to me. So can you explain your logic?
So great question. Great question. The bonds would feel like I've dealt them an unfair hand in this presentation, because I was only showing you bond performance since the beginning of 2022. So I was only showing you bond performance since the Fed began aggressively increasing interest rates. And so the bonds would stand there going, hey, that's not fair. We were doing good for a long time. And then you only show us when we're down, right? Bonds have been a difficult investment for a long time now, actually. Ever since the Great Recession, when the Fed dramatically decreased interest rates, bonds have been relatively low returning. Okay. However, there are moments in time, even in this last decade, when bonds were a lifesaver. Okay. So for instance, when the COVID crash hit, okay, all of a sudden short-term treasuries spiked 15%. Okay. And so at a moment in time where we were all legitimately panicking about maybe the end of the world, right? This pandemic was just going to wipe us all out. Short-term treasuries were your best performing investment by a huge amount. Okay. Now you have to understand the interest rate environment that we're likely to have going forward. Okay. We're not likely to have 0% interest rates ever again. Okay. I mean, or at least, not in the next decade. Okay. It is much, much more likely that we're going to have 4, 5, 6, 7% interest rates going forward. Okay. So yes, Steve, you could be forgiven for going, why in the heck has Jon had me in bonds these last 5 years? They have not been a great performer in your portfolio. But thinking about the next 5 years, now we're talking about bonds making up a significant part of your target performance. If we're shooting for a 7, 8, 9% annualized return, and we're getting 5 and 6% from a relatively conservative investment, that's a pretty good deal. So, yeah, if I could go back in time and, have never bought bonds 5 years ago, I probably would have. But going forward, I think they absolutely make sense.
Okay.
Yeah.
Next question then I have is, again, back to that quilt drawing that you have. You had, of course, all the ETFs. You had the value, you had the growth, you had international, you had Asian. So, and they all vary from year to year. Okay, so the question I have is, they're not all equal weighted in my portfolio.
No.
They go from, really extremes. So what the question, I guess, basic is, why isn't it equal weighted then? If that's the case, where some are up, some are down some years, etc.
Yeah, no, great question. So, for that, and this question relates to most of the people on the call today, right? Why do we hold these other investments, right? Even if we hold them in relatively small percentages. Well, almost all of our clients are doing distributions from their portfolios around 4 to 5% per year. Okay, that's a very typical withdrawal rate. Some of you guys might be a little higher or a little lower. Okay, so again, we go to that question of don't sell low. I need something in the portfolio that's going to be up that I can use to fund that 4 to 5% distribution, okay, for as long as the stock piece of your portfolio is low. Okay, so so during the Great Recession, most times it only takes like 2 years or something for stocks to recover from a drop. Okay. During the Great Recession, it was 5 years. Okay. So if I'm trying to cover a 3-year period of time where I don't want to sell stocks, okay, 3 years at 4% a year or 5% a year, I need 12 to 15% of your portfolio that I can use to cover your withdrawals. Okay, during that period where stocks are out of favor. All right, so I don't need a huge allocation to these other things. I just need to find 12 to 15% of some of these little buckets, okay, that are going to be up in those different quarters while stocks are depressed. Okay, and that's why commodities, most of you guys have about 4 to 5% in commodities. Great, that'll cover a whole year. Okay, most of you also have about 6 or 7% in US and international real estate. Great, that'll cover another 18 months. Okay, the international stocks, the international bonds, each of those will cover like another 6 months or another 12 months, where I can sell something high while I'm waiting for the rest of the stocks to do what stocks will mostly do, which is go up. Does that make sense?
Little.
Okay.
Okay.
You had a third question.
Yeah, the third one, I'm sorry to take up all this time. Well, the third one is, okay, so you showed this graph of the S&P over so many years, and it looks crazy nice. But that's not our portfolio. That's not even a reflection of our portfolio. So how do we know? There's no way, I think, in Schwab where you can map or graph our portfolio. That would be nice to have it compared to the S&P, right? I mean, I'm sure our portfolio did not perform, right, like the S&P did, or else we'd be multimillionaires.
Yeah.
So I guess the question is, yeah, how do you get that information? How do you get that graph of our portfolio?
Yeah.
Graphed against the S&P?
Yeah, great question. So all of you guys have seen our performance reports that we send you, okay? Those performance reports are not generated by Schwab, nor were they generated by TD Ameritrade. They're generated by a completely separate portfolio accounting software that we pay a lot of money to be able to crank out those reports. So every quarter we give you exactly that data, right? We've gone through it together. So you get that at least quarterly, plus we generate one of those reports every time we meet. Now, one of the things that we're working on internally is making these reports available to you guys on demand, where you'll be able to log in and generate the reports yourself and look at that. And we did that in response to so many of you telling us that you just didn't love Schwab. That Schwab was just frustrating. It wasn't as intuitive as you were used to, and you wanted something better. So we've gone back to our business partners, this accounting software that we have called Orion, and we're working with them to create client portals and client reports and a dashboard that I think you guys are going to like. So we hope to be rolling that out very soon. We're pretty much ready with a couple beta testers.
Okay, so you mentioned that we were going to have some tools. Are those the ones you were talking about?
Yeah.
All right,
Yeah.
All right, John. Thank you.
Yeah. Ken, I think you had a question? Yeah.
Yeah, so you had made some predictions about short-term rates and long-term rates. How does mortgage rates track either of those? And what are your thoughts about mortgage rates for the next few years?
So mortgage rates are indexed to the 10-year treasury. Okay. So they follow the 10-year treasury, which is kind of an intermediate term rate. It's kind of somewhere in between short term and long term. I do not expect mortgage rates to go down. That is my prediction. I think mortgage rates will act much more like long-term bond rates, and I do not see them dropping. I think even if the Fed begins cutting short-term rates, we're not going to see a lot of movement in 30-year mortgages. Okay. Now adjustable rate mortgages, those 3-year ARM, 5-year ARMs, those will drop. Those will drop a lot. Okay. Home equity lines of credit, those will drop. But your traditional 30-year mortgage, I do not believe we're going to see much movement at all in those rates, which is not a popular opinion. All right. Any other questions? All right, great. Well, everybody, thank you so much for being on the call. I really enjoy doing these. I hope that it's been valuable for you. And again, please reach out if you'd like to chat one-on-one.
Hey, Jon, thank you so much.
My pleasure. All right, bye-bye.
Thanks, John. Bye.